Morning, gentlemen. Let's go through the PES exam, which is 2019, which was doing this activity here. So you had to calculate the GST, which is a little tricky. So you've got to go through each item and think, is GST applicable? And is it going to increase the GST clearing account with a credit or decrease it with a debit? So let's do the ones that will increase with a credit. So your cash sales, you need 10% of that figure. Your credit sales, you need 10% of that figure. Right? So those two are going to increase your GST clearing with credits, but only 10%. Right? So that's the sales figure, 10% of those. If you go down the rest, payment, they're all payments. Capital contribution, right? So that is money being received, but there is no GST attached to the owner contributing cash. Payment, sales returns, we'll get to. Purchasing, no. More purchasing, so no. Receipts from accounts receivable. So that's receiving money, but the GST is actually already inside that figure. You've already recorded it at the point of sale. So the GST is recorded when you do the credit sales entry. When the money is actually received from the customers, it just goes straight into your bank account. There is already GST inside that figure, but it's already been recorded in the GST clearing account. So we don't do anything more with the GST with that entry there. The loan is a receipt. So again, loan doesn't attract GST. So that's it, right, for the credits for your GST. Let's go through the payments. So this one here is your GST settlement. So clearly that will be a debit, but for the full amount because you're paying the GST that you owe. Right, the next one is a payment for advertising, but you only want to calculate 10% of that. Right, so $55. Payments to accounts payable. Right, so very similar to your accounts receivable. This is the payment that you've made to your suppliers. The GST was already calculated once you purchased it on credit over here. Right, so this one doesn't attract any GST in the GST clearing account. Similarly to this one over here, to receipts from accounts receivable. The GST is already inside that figure and already inside that figure. It's already been accounted for when you did the credit purchase and the credit sale. Wages doesn't attract GST, so nor does accrued wages. Capital contribution we've done. Loan repayments doesn't attract GST. Interest paid doesn't attract GST. Now sales returns, there is a GST component. This is the opposite to your credit sales. So this one here, this is the cancellation of one of those. So if credit sales up here is going to credit the GST clearing, we need to debit the GST clearing. But again, only 10%. Right? So $32 is debited. Cash purchase of inventory, so that will be a debit, 10%. Credit purchases of inventory will be a debit of 10%. Equipment purchases, debit to the GST clearing, take 10% of that figure. Interest is not GST. Prepaid rent, yes. We want 10% of that figure as the payment. All right. Revenue, discount expense, no GST attached to those. Receipts from accounts receivable, right? So we've done that. That is the money coming into the bank account, but it already includes the GST inside that figure. Loan, no GST attached to that. Inventory loss is an accounting entry. There's no GST attached to that. Freight in, yes, we would have to add our 10%. Right, so $40 will be a debit to the GST clearing account. Right, so you go through and do all your entries. Once you do the statement of cash flows, then all of the ones in blue will be your GST paid. Right? And obviously the green one will be the GST settlement. Right? So fairly straightforward once you know what to include and what not to include. So these figures don't have the GST in. So the ones in blue, you've got to take 10% of those figures. Right? And not the interest paid. That's not totally shaded. And the two in yellow, they're the ones that go onto the credit side as an increase to GST. So go over that. If you're not sure, then get back to me. All right, so the solution to that one, once you've done all that, will look like this, and I'll put this up as well. So there's your GST settlement, the cross-reference bank, then all your purchases with bank, cash purchases, your credit purchases of inventory, and there's your sales return. On this side, you have your cash sales, you have your credit sales, and then you balance it off. Okay, so the next part was to do the statement of cash flows. All right, so that's just taking all that information there from the transactions for the month. So cash sales plus your 10% GST, receipts from accounts receivable, and interest revenue. So you take the figures straight off the question, and then you do your outflows. So what we're making sure is we don't include drawings, loans, capital, or purchases of non-current assets. Everything else is going to go in operating. And the outflows are always shown in brackets. So we've got a net deficit of 3,565, which, as you know from the previous topic, notes and graphs, that's a disaster, right? There's no internal cash being generated by this business at all. And you just simply write in the items. So as long as you get all of the items, the only one you had to be careful with was this one here. So you had to go back to the previous question and add up all those GST payments to get that figure of 2,555. The GST settlement was just a one-off figure. So that should have been straightforward. So hopefully that was all good. And then your stock standard definitions. So net cash flows from financing activities refers to the difference between inflows from financing activities such as loans and capital and outflows. And you could also mention in there about that they relate to the financial structure of the business in terms of how is the business funded and financed by the owner and debt. Okay, so that's it for the PES question.